Post this recent Fed decision, where are the markets heading this fall in 2023? Hello, this is Chart GPT today. Well, the Fed has spoken last week, and we're starting into the trading week here. Of course, the decision was to hold, but they came out very hawkish, saying they may raise rates higher. So this is the question going forward: where were interest rates going? Of course, interest rates will have a lot of bearing on where stocks are going, inflation, commodities, etc., etc. This is going to be more of a macro view of it, but I think you get the idea once we go through these charts where we're thinking the predictions are going to be. First of all, let's take a look at that yield curve, and you can see at the short end, you can see around the 5.5, but on the tail end, it's kind of coming up a little bit there around the 4.5. So there's a little bit of reduction in the yield curve. You can see this in a longer term chart. The yield curve has actually come off a little bit, so that indicates some positivity in the market. Now, getting into the dot plot and talking about interest rate, where are we going? We've had similar charts, a slightly different view of the same thing that we've already said before. Of course, the blue line are the people's view, or the open committee's view of where interest rates are heading. Of course, we're there at the about 5.5, so they're all in sync there. But the seems to be that it's going to trail off, but not that much. Maybe back through, it'll take all 2024 basically flat, maybe slightly down. We believe that'll come off a lot harder than that they're letting on. I think they're basically jawboning the market to try to keep rates higher, at least through the end of 24, and then into the elections period, it'll hit around maybe 2.5, and then from there going back up. And after the elections, I think we'll have another story. Well, let's take it a day at a time, or at least a half a year at a time here. So we believe it's going to come up a lot farther than what the Fed is letting on here. They're jawboning the market. So we see the interest rates coming off just in time for the elections. In terms of equities, they do this to us all the time, and there's some seasonality in terms of the weakness in September, October, November, and then generally get some uptick with some tax adjustments in December into Christmas time. So this is generally a fairly weak time. And so we're looking, and of course we have this potential government shutdown. I don't know if they're going to be very serious about it. They might be shut down a few days, but they'll survive over it, but they're going to make a political show out of it. And of course what they're all fighting about, is they have a reason to fight, is that the public debt is off the charts. Longer term, this is a very serious issue, but we're only going to look 3 6 months to a year out here for now. But longer term, obviously this is a formula for disaster going forward, which is another story. Again, we're a little bit lower short-term focus. Right now, the interest rates on the U.S. debt totally, if you average out all the short-term, long-term, is around 2.29%. Of course, that's rising. Of course, this is going to become a larger and larger portion of the government budget. So in the out years, it's going to be a disaster if they don't do something. Of course, that's what all this fight is about. You can see here the kind of the yellow line, or the gold line. It'll be, by 2050, if we continue on this trend, it'll be more than discretionary, defense, Medicare, Medicaid, Social Security. All these will be lesser items than the national debt. So they're going to have to cut someday. When? Who knows? Whether they do it this time, I don't know. Of course, they're tying it in with Ukraine funding as well, that part of it. But they're probably not going to do any serious things on this, and so this trend is probably true, and that something is going to happen. But I suspect something will happen before this disaster will occur, because obviously this probably is not going to happen. Of course, here's a look at that debt ceiling. We're already past it. They've got, I don't know how they get away with it, but they got this debt ceiling and they need to raise it. Currently around 33% in total debt for the U.S. government. So there's where we're sitting and need to raise it. Depends on how high they want to have the next crisis as they come. But getting into the stocks itself, the one chart that I wanted to show that kind of caught my eye here is the corporate profits as a percent of GDP. Now, historically, you've seen the trend line since 1950. All the way to the year 2000, it's been about 5.5%. Had the spike up into the 2008 subsequent crash down, and of course now they're back up at 11%. This is a historic record. So profits is as good as it's going to get. So in order to bring it down to trend line, you'd almost need 50% of the stock market would have to crash. So as that's in the cards, a lot of people are predicting that. So, but it is true. The percentage of profits to GDP is off the charts, and chances are it's probably hitting a peak in here right now. So something's got to change. However, remember, profits could come off, which would make the stocks fall, or inflation. Of course, with those interest rates we talk, I believe the inflation gearbox will start churning again, and we'll have huge inflation going into 2024 and into 2025, and so the profits will start coming up to bring that naturally down, as opposed to having stocks come off in price. So that kind of affects our view of where the stocks are heading. We might get a little scare here, and of course we're all hoping for a scare to get in. I know some of us have some money trying to put it to work, looking for a big crash. I would say there's a 20 to 30% risk. You got the Ukraine situation, China, all these geopolitical things, maybe another virus coming, who knows. There is a 20 to 30% risk that we could be heading some very serious crash, as some people have predicted. But I say that that's less of a risk. There's probably a bigger chance that there's a 70 to 80% chance that we're probably going higher. And that's on the back of inflation. Check the AI out, and you can see that stocks have been historically a fairly good hedge against inflation. So we might back off here into the weakness period of September, October, November, back off a little bit, what is it, about the 4,200 on the S&P, and then rock it back to all-time high, maybe jiggle-joggle off the top into mid-near next year, have a rally into the elections that even go to new highs in 2024. So that's kind of our view of where the market's going, as well as the credit market's going. Of course, on the commodity sector, with that inflation, commodities could go much higher from where they're at now. And the trick of the Fed will be is to try to keep it within a range so it doesn't get too far out of hand. With that, the net result of all those, it gives you an idea of a macro view of where we think the markets are heading. Give us your take on the polling. Do you think markets are going to crash, or do you think they're going higher or go nowhere? Don't forget to subscribe.